government servant. I'm covered under central government health scheme. I'm aware of the reasons which are not applicable in my case, due to which you recommend a health insurance apart from one provided by the employer. Do I need a separate health insurance apart from CGHS? No, not really. If you think the CGHS coverage is good enough, but CGHS services, or the services provided by them could be quite inconsistent. For example, I know it from my personal experience because my father is also a central government employee and a retired one. He has a CGHS coverage, and I find that in Delhi, it is first class. You have many hospitals where one can go, investigations, even the diagnostics. One gets a CGHS entitlement in terms of discounted rates and other things. So there are large, great facilities available here. But it can vary in different cities. So I don't know where you live. Just find out. And also see who all are covered in the CGHS. If you have some dependents who are not covered, then maybe get that health insurance. Because in early stage, the idea of a health insurance is that a big expense comes your way on this account, which is not negotiable. You have to spend that money even if you have to borrow it. It will derail all your investment plans. So just to be cautious about that, it's buying that protection. So evaluate yourself. CGHS is good. Maybe a small supplementary health insurance cover for hospitalization, other things. But it's time that you take a closer look at what all is covered in the CGHS. The problem is that CGHS, once you have the CGHS employment, the CGHS entitlement, we don't have a mechanism of co-pay that a part of it is coming from CGHS and the supplementary thing can be provided for health insurance. I don't think hospitals provide that, but it will be worthwhile to understand these nuances and act accordingly. Rohit Saxena is asking that do you think RBI has introduced a lot of liquidity in the market and the inflation will hit an all-time high? Is it better to move away from stocks and bonds and invest in the gold bonds and gold mining companies, as inflation will depreciate the value of rupee in the coming future? I don't know. There are mixed things. I don't see inflation making a big comeback. There can be inflation in certain part of our because the supply chain is disrupted. We are not witnessing huge demand or consumer demand. There has been demand destruction, so to say. So I don't see inflation making a huge comeback. Of course, there are constraints. There will be inconsistency. There will be supply chain disruptions that can lead to some temporary inflation in certain regions about certain things, but not in a fairly generic way. And also, I feel that RBI will be doing something. I don't think the RBI has done enough on the liquidity front. It has done some steps has been taken by the government, by the RBI. But nothing compared to what has happened in the global arena. In many economies, government have gone about giving away money to people to spend. We haven't seen anything of that kind. We have seen that in our country, where there's a large population which is impoverished and they have lost their income source of income, a very small amount has gone to them. I don't think it is. It is basically to rescue. It is helping the desperate. It is not helping to. It is not there to revive a demand of a meaningful kind. It is basically a sustenance allowance given by the government in that manner. So I don't think inflation is lurking around. Sunil Jacob is asking that okay, you had another part of your question, that should we move our money from stocks, bonds, and I don't know. I think markets are unpredictable. And even if something happens, when exactly market will start behaving, because there are just too many moving parts which drives the market. If a lot of investors continue buying, then markets, despite all the negatives, may not come down, and you might lose a big opportunity. I think don't work on your asset allocation plan. And if there is a huge stocks to bonds, bonds to stocks, or if you have a defined allocation to gold, but don't do it based on your outlook. Do it based on your allocation. If it has changed, make those changes. Sunil Jacob, and COVID has only added fuel to the fire. The market seems heavily overvalued currently. So does it make more sense to book profits in equities and move towards debt to preserve capital? As I was saying that, set your asset allocation and act accordingly. When it goes out of outlook of the market or it's very expensive, market has been expensive, for a long time. And before it became cheap. And when market becomes very cheap, we are too scared. So to navigate this greed, fear, and all the nuances of the market so that we don't profit from it. Because when it becomes very cheap, it's important that, you don't invest. So have your plan, and that plan should guide your actions. Manju Shankar is asking that why are there no all stock or wide range index funds in India, just like S&P 500? What's stopping fund houses from launching these patterns who invest in Junior Nifty? And Junior Nifty, which is, the next 50 stocks, it is stock number 51 to 100 stocks generally. Even there, replicating that index becomes difficult if there is some of those stocks hit circuit breaker. So in that sense, and that leads to lack of depth in the Indian market. Nifty 50 is easy to replicate. We have enough depth there. We have enough depth because FIIs, they are institutional investors, and they invest in that big fund stocks. But beyond that, lack of depth in the Indian market, it can improve. There was a mutual fund which was launched, which was S&P 5, equivalent in India, and it was an OMD stocks. 100 stocks were untradeable. One can theoretically, it is easy to actually look at the stock prices, put it in an Excel file, compute the index. But the replicability of the index, that if you are ability to sell those stocks, is just as important. So we don't have enough depth. Maybe in a couple of years from now, when greater institutionalization of the market, when we have large number of institutional investors, then we will have a broader market. Ahuja is asking that, what do you see the role played by banks after this economy crash? Would they become 6 months with all this going on? Interest rates are primarily guided by the need to boost the economy, to release, and also guided by supply chain issues or supply side issues which can drive that. But I'm not an economist. I'm just telling you based on what I have seen. Historically, 10-15 years, how central bankers behave when they have to do something to correct. And these are the two important tools, economy. These are two economic tools, in their hand. And I don't see, and of course, banks' behavior, restructuring of write-off that we have seen in the public sector bank, which account for substantial part of the deposits in the economy. They have a very important role to play. Most of the public sector banks are undergoing some restructuring. Recently, we have seen the big mergers. 4 public sector banks, large public sector banks getting consolidated with others. So I think, we need some more reforms in terms of more transparent, accountable management, which is able to go and behave exactly like a private sector bank does, that, they are lending money, but they are not distributing money. They are lending money to get the interest and principal back. Maybe there will be NPAs, but not lending money in a manner that it is more likely to become NPA. Objective lending is as important. And in that sense, I think that, banks have been cautious for a while, and they are likely to remain cautious. There is unlikely to be a change of heart. And there are pluses and minuses of, liberal lending in the economy. That does not lead to greater efficiency. That does not lead to, efficiency of capital, which is put to good use, which generates return, which supports the interest rates. Yes, the interest rates have come down. Good borrowers are unlikely to have any problem. So the whole configuration is about getting bigger. And I don't think, good borrowers ever had a problem of, liquidity. Real issue is bankers are unlikely to be distributing money in the future as easily as they have done in the past, given their own experience and the kind of greater accountability. But we have to see what next the government does in terms of unleashing these banks, which are sitting on huge deposits and they are lending it. They are actually putting it up with RBI. Nishant Chitlur is asking that I invest in stocks and mutual funds, and I have noticed that after a correction in the market, mutual funds take a lot of time to regain the original ground compared to the time taken by stocks. Why are mutual funds so slow to show gains? Yes, mutual funds are a relatively steadier version because of a general level of diversification, greater diversification, and your stock portfolio just might have 4 stocks, 5 stocks, 10 stocks, 15 stocks, and maybe you are a good stock picker. They are able to recover faster, or maybe you are a bad stock picker, but so far your experience is limited to the limited universe that you have invested in, and that could be true. When you invest in a mutual fund, you are generally going for diversification in a programmed manner, and I would say that even mutual funds, or even on the decline, they will be relatively you would have seen a steadier decline, or not as free fall, because it's very straightforward. And you also have some mutual funds which fall freely and make a big comeback. Likewise, you have stocks which fall very dramatically and then they make a comeback very sharply. So it entirely depends on the character of the portfolio. I don't think, and of course look at the level of diversification, but largely I agree with you that mutual funds might take longer to make a comeback as compared to narrower or concentrated portfolio sometimes. Ashish Pandey is asking that when initiating SWP, option of capital appreciation or fixed withdrawals are available. What is the difference and which option should we go and why? The capital appreciation option is that whatever be the capital appreciation, you don't do a fixed income, fixed amount that you have invested 10 lakh rupees and now you want something like 5,000 rupees a month. That is fixed withdrawal. You define the amount of money that you want at what periodicity. That is fixed withdrawal. And when you give an instruction to the bank, the capital appreciation is like a standing instruction that on a month-on-month basis or at any defined periodicity, whatever is the appreciation, that money is returned to you. Both are the same thing, except that one is fixed and the other is in the capital appreciation option. You have the comfort that your capital is intact and you are only taking the gains. But that is actually not true, because for your capital to be really protected, it must also grow to some extent. Assuming that you have a lakh of rupees and you decide to take 1,000, or you decide to take only the gains. So if you keep taking the gains from that 1 lakh rupee, 5 years from now you will have a capital which has been protected, which remains 1 lakh rupee, and periodically over the next 60 months, over the next 5 years, whatever was the gain was returned back to you on a month-to-month basis. That is the capital appreciation option. The problem is that your 1 lakh rupee 5 years from now will not be the same. Your 1 lakh rupee today is not equal to 1 lakh rupee 5 years from now. So in that sense, you have to be a little careful to really protect the worth of your capital. You have to withdraw less than, or you should be withdrawing less than what the total appreciation. Because if you consume all the returns, your capital will remain constant, which in real sense is going down in value because of inflation. Ganesh Birdar is asking that I have invested in ULIP and my lock-in is for 5 years is completed in August. My investment amount was 1 lakh per year, which is 5 lakh investment till now, and its current value is 5.2 lakh, just 20,000 profit in 5 years. I'm planning to surrender the policy. Are there any chances of growth in market, or so I can wait? Yeah, there is always a possibility of growth and decline in the market, and I think the market, if you do a survey of all the investors in terms of what they expect, I think there will be more investors who will think that the market is poised for a correction than a rise. But don't go by any of that. The primary thing is that you have been investing 1 lakh rupee, you have got this appreciation of 20,000 rupee. It may not be good enough, but this is not the right thing to compare with an index or with a mutual fund. Even a mutual fund would not have given you great returns. During this period, last 5 years, we have seen that the market went up, then it went down, or it actually went down in the first 2 years of the recent 5 years, and then it made a comeback, and then we have seen this big correction, and that big correction in March, we are about to recoup that those losses. So the fact is that you should be withdrawing money from ULIP for a very simple reason. You should be investing in a mutual fund, and you should get adequate term cover, insurance cover from a term insurance, and that is a simple policy to be followed. So go and buy your term insurance. Start paying that premium. For a small premium, depending on your age, you will be getting a large insurance coverage, and make sure that you are taking a liberal one. While you are estimating the needs for your family, that in case you are not around, how much money is needed. Get that term cover. Once you get that term cover, initiate your premature withdrawal of this. Get into the policy details, because what are the surrender charges? In most cases, the surrender charges are very low after 5 years. So, and then initiate your investment plan, 1 or 2 multi-cap fund, or the tax saving fund which you need. If that was the reason why you invested in the ULIP, initiate that and get going. Faisal is asking that last 3 years I am investing in Franklin focused equity fund. Even after the market recovered from COVID-19 crash, the fund is giving negative return. Recently, value research rating has also declined to 2-star. Please advise me whether I have to shift to another well-rated fund or to continue. Yes, we also like this fund, and this fund has shown relative, underperformance. Give it a few more months and then withdraw. Move your money to other fund. It was a good fund. We like many of the Franklin fund because they are reasonably quality focused on the equity fund, and many of the funds have great long-term track record. But this has been a disappointing fund on a relative basis with superior options available. So one can change. Rohan Gupta is asking that in the NPS section of my investment, please add option to manually add investments whenever done. It is better and quick as compared to uploading statements for each transaction. Yes, I take your suggestion. We will be implementing it at some point, but I will tell you why we do this. Inputting a NPS transaction is complex because depends the expense structure. Unlike a mutual fund which you buy it at NAV, of course you buy your NPS, and NPS funds are also getting allotted at NAV. But the expense, the transaction cost, is a separate entry in your transaction. You would have seen it in the account statement that when you put 500 rupees, 50 paisa goes towards the POP and this and that. It is very transparent. It is not expensive. But in the NAV, a very small part of the expense is there. The transaction charges, the entries are entries are to be passed, or one has to input those entries for the transaction charges also separately. So we thought that it will be complex, it will always be easy. But I take your suggestion that once you have done your bulk upload from the account statement, subsequent entries could be far and few, and it will be easier to put your transaction manually as well. So we will enable it at some point. Right now we are too busy, working very hard, and that too, given the constraints, operating constraints that we are in, we are working very hard to launch the premium service. But after that, we will definitely have it on our task list. That your ability to input NPS transactions manually subsequently in future. Hari Krishnan is asking that I'm investing in Motilal Oswal NASDAQ 100 fund of fund. This week I got a mail telling that they are planning to create segregated portfolio. My understanding is that this happens when one or bonds that they have default, they invested has defaulted. Should I continue my SIP in this? What is your suggestion? Yes, it could be a small part, and yes, segregated portfolios get created. But in case of NASDAQ 100 fund of fund, very insignificant part of the money is invested in bonds. That is normally a parking ground, and it is supposed to be investing substantial part of the money in the NASDAQ 100 fund. So I'll get into the greater detail of this, but not much to worry here. I think the bigger worry is that the decline that we are witnessing, and don't get unnerved by that. NASDAQ 100 is witnessing a decline. Yesterday NASDAQ went down quite substantially, 4-5%, and even day before it went down, and it has been steadily going up. Last 2-3 year return on NASDAQ has been 20% annualized, which is quite substantial. And this is a portfolio of high quality companies which have turned very expensive, and but don't do much about it. If it is your international allocation, stick through this, carry on. I don't think that segregated portfolio, it's your money, and it as and when it gets recovered, you will get a reasonable part of it, or all of it, or maybe much more than all the interest as well. And that has been the experience of many of the segregated portfolio which have been created so far. Quite a few of them have been resolved quite nicely so far. Ali Asghar Mansoor Khambati is asking that my father is retired and depend on fixed income for his needs. His FD will mature in October 2021 to the tune of 75 lakh. He has enjoyed over 10% of his fixed deposits and hopes for similar return going forward. FDs now give only 6%. What shall he do if he has to make a 10% return by taking some risk? Yes, he has to take some measured risk. When you grow older, and more so for a person who is getting old now and is retired, he has no experience of the madness of the equity market. Equity market turns out to be rewarding, but it also turns out to be very unnerving for the kind of behavior that we see, and it causes a great deal of anxiety. So move with, I think that is the time when he will have to invest a modest part. He will have to create a ladder of fixed income investments first. For example, the senior citizen savings scheme, which will get him the highest possible return, which will still not be 10%, but it will get him 7.1%. Then going for the post office MIP, because he will be getting 75 lakh rupees, 15 lakh can be invested there. So a good part of it can be invested in very safe instrument. Remaining money can be invested in more conservative, equity income scheme. These funds typically have 35% money into equity. They are the best hope, in the sense that because just having 75 lakh is one thing. There is also a need which you should be aware of, that his 75 lakh rupee, remaining 75 lakh rupee is important. But that 75 lakh rupee also growing despite the withdrawal is just as important. Because if he takes 10% return, 75 lakh rupees will just translate into a return of 7.5 lakh rupees, which is about little over 60,000 rupees a month, which is good enough. But that 75 lakh rupee also has to grow, because 5 years from now, if he needs 60,000 rupees a month, 5 years from now or 3 years from now, he will be needing more, with adjusted for inflation. And that is why that capital also needs to grow. So plan things, understand things, and approach it conservatively. Maybe 2 things to be done as and when he gets his money. That first, he should invest in the senior citizen savings scheme, post office MIP, and the LIC scheme for the senior citizens. And after that, invest in equity savings fund, which is the best promise, which can generate higher return, not very high return, at the same time with low risk, and hopefully he's able to get closer to 10%, and maybe if he's withdrawing little less during this period, he will be also able to grow his capital a bit, which is important. Jomi Joseph is asking that, can you explain the technical term alpha generation for long-term investment in layman's language in simple method? Okay, every layman has the it's very hard to actually tell in layman's language, but I'll try. Which is most investors have the choice of investing in something which is risk-free. For example, the post office recurring deposit, or which is equivalent to a SIP, but your capital is protected, the interest is protected. Likewise, the other option you have is when you are investing in equity, that you don't put effort in choosing which fund to invest in, or trying to evaluate the brilliance of a fund manager or brilliance of a strategy of fund management. You always have the fallback in terms of the most risk-free equity investment option is an index fund. So if you do nothing, you earn as much return as index. So when you entrust your money to an active fund manager, you have to, it assumes that the alpha, the concept is based on that all the information available in the market is reflected in the stock price. So it is very difficult for investors to add value, because the market is very efficient and it factors all the price, all the information and news and outlook is reflected in the market price. Market is very efficient. But the active fund manager, what he's attempting to do is that market is not efficient. He's trying to look at mispriced opportunity. He's trying to look for opportunities where market is thinking something, or it is reflected in the stock price, but he thinks otherwise. So that is why you choose an active fund manager. That here is a fund manager who will do things which is not like that of an index. And when he's taking those actions, what is the amount of return? And here on a per unit of risk, or for a given level of risk, how much is the extra return generated by the fund manager? That is in a nutshell is referred as alpha. How is a fund manager beating the relevant benchmarks? Because different funds can have different benchmarks. So a relevant benchmark by assuming risk, because if there's a fund manager who's generating high risk as compared to index, but he's also assuming great return, high return as compared to index, but also assuming great risk, which is captured in the in a formula of volatility or standard deviation. So that will be, so if one is assuming great risk and generating great return, it may not have great alpha. A high alpha means that one is generating higher return than index by assuming lower risk than index as compared to index. So higher the alpha, better it is compared to index. But I would say that keep it simple. Look at a fund which is doing better than index in a falling market, falls less and rises more in a full market cycle, and the fund manager is still around, because this alpha and the kind of things. You heard the other question that why we don't have too many index funds or the kind of broad-based index. So index and all these, so these are all coming from very efficient or advanced markets to our market, and of course theoretically, academically they are fine, they are rooted in academics, but one has to see that doability of all this. It should be one of the things which you can look at, and at Value Research Online you go to the funds page and you look at the portfolio part, and you will be able to see all these numbers, alpha, beta, R squared, Sharpe ratio. So look at that, understand, it's good to know, but I don't think that should be the only driver. Lakshmi Kant is asking that how frequently mutual funds upload their, disclose their holdings in for Value Research website. Is it every month or every 2 months? No, mutual funds disclose their portfolio, full portfolio to us every month, and we start getting it from 2nd of every month, and by 7th, 8th or 9th of every month we are almost done with 100% of the portfolio disclosure. So you can look at the portfolio part of mutual fund. It is disclosed every month, and Value Research website is updated the fastest, because we have devised a mechanism that in 4 to 5 hours time, however large the portfolio be, all portfolios of disclosed by mutual funds reported to us are uploaded, or are assimilated in our systems with quality checks in at most 4 to 6 hours time. Abhijit Sikdar is asking that which sector to focus as a priority in the current time. I don't know. And Manoj Arkadi is asking that I subscribed to the Value Research Stock Advisor recently. Among the best buys and all weather, many stocks have run up substantially, 50, 60 or 100% in the last 6 months to 1 year. Are these stocks still worth buying at these prices? And we need to wait for meaningful corrections for buying. You need to, if there is a need to make a sell recommendation just because the stock prices have gone up substantially and they are very expensive and we are not very hopeful of it, their future outlook, we will issue a sell recommendation. No. We are still very confident of these companies. There could be interim correction. There could be an interim correction, and that you have to deal with your asset allocation. But the companies in the best buys, but that is not true. What you are saying is that there are companies with 50%, 60% or 100% return in the last 5-6 months. Yes, there are. But there are also companies, which have gone down by 30%, 40%, and they are also in the best buys list. Look at them. In fact, if you look at the most recent re-recommendation that we have done, which was part of the best buy as well, it is a company about which we feel very confident about, and we think there are great things happening to that company. But it is and because it is down 30-40%, it has been re-recommended. It is part of the best buys, and I think it is there's a compelling situation that has been caused by that. So no, the best buys, and there could be companies, in few weeks time we will make a re-recommendation about a stock where the stock price has gone up by 100%, but we think that now this stock has to be held for next 10 years. Don't miss out the big opportunity just because the stock price has gone up, because when you get hold of a great idea and it still have a lot of steam left to run, we have this company where in 2 weeks time we will be making this re-recommendation. It has gone up dramatically, and we think that this can be a multi-bagger in 5-7 years time, just because a lot of air has been cleared, all the kind of uncertainty has been cleared, great capacity has been added, and we see a huge the innings ahead of it. Amlan Basak is asking that any plans to launch VRO mobile app in the near future? Yes, absolutely. It will follow after our premium launch. Swapnil Mangle is asking that thanks a lot for valuable suggestion. Please suggest relevance of having ELSS in the context of new tax regime, wherein exclusions and deductions are not allowed. Thanks. Right now you have the choice to go with the legacy tax regime, which is with all the deductions and with the older methodology, or go with the new regime that you don't want any deduction and you pay this flat tax and end of the story. If you are choosing for the new method, you don't need to worry about ELSS. But for some reason, if you have some entitlements, perks, and for your income level, for the kind of salary that you get, for the kind of perks that you get, for the kind of deductions that you get, the older methodology for following the older tax calculation methodology is beneficial to you. Then use ELSS as well as NPS, the extra 80CCD, which entitles you for additional 50,000 rupees investment. Otherwise, if you are going for the new method, of tax calculation and you earn over 15 lakh rupees, that is the case where it doesn't matter. It is better to follow that. So make your choice depending on what is beneficial to you. Tax save is money earned. Vamsi Raghu is asking that as per Value Research article, a senior citizen individually has to have a health cover of 10 to 15 lakhs, which results in an annual insurance cost of 70,000 rupees. Why not accumulate a health fund in parallel to emergency fund of this value over the years with inflation included? Your advice, please. Yes, absolutely. In fact, one should always err on the side of caution, and you should not be dependent on the insurance companies for your old age health coverage or long-term care that you might require. In fact, long-term care is not available in India of a kind which most people need as we are living longer. So you will need a lot of support system which may not be covered by the health insurance. You just might need a support. or you need which may not translate into hospitalization or some kind of intervention. So I would say that yes, why not? If you have that money, then for example, and that is the principle which has to be followed with all insurance. You go for term insurance, but if you are able to build enough net worth, stop buying that in term insurance, because you don't need the term insurance. Term insurance is buying protection for your family because it is not covered by your net worth. Once you have a net worth, for example, if your family needs 1 crore rupee today, if you don't need it, if you are not around, and 1 crore rupee is the amount which can support them with the income and other aspirations or other needs in their lifetime. So you go for a term cover of 1 crore rupee. But assuming that your savings and accumulation have grown to 1 crore rupee, that is the day when you don't need the term cover. So have your principles clear. If you are able to build that corpus, or if you are able to accumulate savings to an extent that can take care of the health insurance needs as well in your old age, by all means do it. And that is the time when you don't need the health insurance. Or buying a health insurance at that age could be a choice. It will be a discretionary choice that you want to have the supplementary option of having a health insurance over and above what you have. But those coverage as you get older becomes very expensive. Ashutosh Sirotia is asking that how does the global scenario impact India, the US news and record high unemployment, indiscriminate printing of dollars, and record high stocks in the US market, all signs of a red flag. All are red flag. Is our economy also on the brink of collapse? Yes, our economy is in difficulty. So are global economies. This is a global pandemic. It has affected everybody. Different economies are trying to rescue their economies in different manner. I don't know how this will pan out. It's still, we have seen that, the GDP numbers came out. I don't believe the GDP numbers because GDP is still a guesswork. Even the calculation of GDP at this point because of the pandemic may not be, because GDP is based on survey. So, and it would have been very difficult to do those surveys as well. So what you see is a 25%, 26% or a 27%, the largest ever decline in a quarter in our country ever. So these are all red flags, and these are all anticipated. We were not expecting anything better. So this is going to be a problem, but we still have to see that this is a problem which is likely to get resolved in some period of time. The problem is that we don't know when. Is it going to be 2 quarters? Is it going to be 2 years? Is it going to be 3 years? Will it lead to mortality of some companies? Will some companies become irrelevant as a result of behavioral changes? These are the greatest uncertainty, and I think this is not a financial crisis. This is a crisis which has a spread across geographies, which is having an impact. We are looking at all the unlockdown or unlocking of the various economic activity. This can translate into surge in cases again. This can lead to recurring of the lockdown again. I don't know. We are living in great uncertain times. Because of the economy, we are unlocking, and because of the unlocking, it can lead to a surge, which can lead to lockdown again, which can lead to disruption again. So we don't know. We are living in this great uncertain time. Brink of collapse? No. There will be collapses. There are businesses which will collapse. There are businesses which will benefit. There are businesses which will benefit on account of. There are businesses which will suffer for a period. There are strong businesses which will stop making money, and they will start making money again as and when they get stronger, or the economy opens up and normalcy is restored to a reasonable extent. We are witnessing that news all the time. The Indigo airline is expecting that 75% of its capacity will be back to work again. Cinema halls, they don't have a site right now, but maybe if this prolonged crisis continues, maybe some cinema hall will turn into something else, or maybe the capacity will get reduced dramatically, or people's behavior will change, that they will start enjoying many things on all the Prime Video or all the kind of things, that modern thing which is getting delivered in your home, and so it can translate into a lot of behavioral changes. It can translate into I think business travel is definitely going to be curtailed substantially for a prolonged period of time, even if the capacities are restored. Maybe many of these businesses will have to change. And business, good businesses survive when they are able to navigate these changes. In normal times also, good businesses have to change. In fact, they have to continually change. This is a time when many businesses have to change dramatically. So some businesses will die simply because their inability to change otherwise, or their inability to change or pole vault into something completely different. Many businesses have to pivot. They have to change completely. And that is something, that depends on the management, that depends on the kind of people, that depends on the kind of culture they have. So I don't have an answer, but I am an optimist. We are generally betting on all the things that India stands for, that we are a bunch of young people, we are confident, we have a government which is proactive, many things have been done, many reforms have been initiated as in this framework of this pandemic, which it has been used as an excuse, which would have been otherwise impossible to implement those changes. People will be more flexible, costs will come down. So banks have been restructuring. So I'm hopeful that it might take time, but we will be back to track again and on route to recovery, simply because many of the variables are very nicely in place. Yes, this is a huge speed breaker, and how long it is going for us to repair ourselves or get back on track again, I don't know, but it's only a matter of time. So that is why that investment time frame is important. If you are trying to benefit from the punt on this market, don't do that. It can take a couple of quarters, it can take a couple of years. So all the best, be optimistic. When we are investing, we are betting, it's a general bet on economy, and I think tailwind will come back again. So thank you very much on this positive note in a very pessimistic pessimistic world we live in, or all the damning things that we are seeing around. So wish you very best, and see you next week once again.